matters tech. And we want to start broadly. They say that we come with good news and bad news sometimes, and today we're talking about tech layoffs. Now in 2023, we saw more than 240,000 roles leaving the tech industry globally, with many tech giants shaving their workforce throughout the year. And now in the second month of 2024, the trend still persists. And to dig deeper into this, I'm joined by our tech guru himself and host of Tech Files right here on KTN News, Kelly Boss, with an analysis of this particular situation. Will it land in Kenya with these layoffs or not? Over to you, Kelly.
Thank you very much, Noah. And shaving their workforce indeed. And I'll start this tech layoff conversation with what happened in 2022, because we had never had this type of conversation. But towards the end of 2022, in November 2022, to be exact, there was a lot of layoffs, and that came out of the Silicon Valley. And this was because just before this was the pandemic. If you think about it, it was around 2019, 2018, 2020, 2021. So these tech companies really needed a lot of tech workers, and so they inflated the amount of people they used to use. And after that is around 2022. Towards the end, they thought they should get leaner and just get like any other, legacy company. Because if you think about it, tech companies way back used to be one of those, silvery type of company, but right now they're as legacy as the next company, and they're in the stocks. So for you to survive in the stocks, you have to maybe survive by getting a leaner company. And as the new Facebook CEO talked about it just yesterday, he talked about working with efficient, so a year of efficiency. So I think even as we are going to talk about layoffs, you shouldn't be so, afraid of whatever is going on. It's just that these tech companies are becoming the legacy companies, and they have to work with efficiency, and getting lean is part of being efficient. So when we look at these numbers, if you look at it, 2022 was the worst year, because the 165,000 layoffs was almost the last quarter, because we had never experienced this before November. And then come 2023, it had nearly 50% increase from 2022, because the pattern kept on going. And then in 2024, that's now where the problem is, because we thought towards the end of 2023, we are losing this pattern, because we saw maybe the last 4 months could have an average of 9,000 layoffs. But in 2024, it started on a high. It looked like nearly 2023, but 2023 started with around 90,000 layoffs in January. But at least this has around 30K in January, and then February looks like it will end with around 20,000. So if we go to the next slide, the biggest tech layoffs, I think, in January especially, or so far this year, is PayPal. I've seen PayPal because late last year they had 2,000, and early this year they've already hit 2,500. And this makes up around 9%. This is the biggest, not because of the numbers, because some of these guys have 8,000. But really the percentage is maybe lower. But this hits around 9% of PayPal. And some of these other companies, you can mention them, companies that have set up in Kenya, really big offices. So this directly impacts the local tech employee. And of course, as we move on to the next slide, I think the posture of tech employees, I don't think should be that working for tech is bad. It's just that as you look for tech employments, you should look for security too. And then some of the tech layoffs that have happened in Kenya, as I've mentioned, Microsoft is one of them that has their offices around and laid off a couple of Kenyans. But as I said, look for security as you look for a job in Kenya. Companies, as we move to the next slide, like Sandy and Twiga Foods also really got people off. Now, this slide is what I'm interested in now, because the reasons why these layoffs are happening is because, as I mentioned earlier, during the pandemic, there was a lot of inflated type of employment from these tech companies. And the reason why is because, demand. Zoom comes up. Zoom was available always, but because of the pandemic, they bloomed as a company, and they had to hire much more. Right now, they are one of the companies that are laying off people. I just couldn't get hold of their actual numbers. They could be a very good example to explain the pandemic hiring hinge. And because I don't have time, I'll move on to this list. Don't move on from this slide. I'll continue this list so fast. And the shift in business priority is in this, these tech companies work in collaboration. So for example, LinkedIn as a company could be a company in itself, could lay off maybe, say 1,000 people. But the companies that work with LinkedIn or support LinkedIn in terms of maybe the educative part or, the other systems in LinkedIn could be now, maybe if LinkedIn are shifting towards AI, some of the companies are like get the collateral damage and everything. And then finally, Noam, on the benefits to being leaner. This is a mention that was done by the Meta CEO just recently, is that as these tech companies grow, they compete with other companies that are not basically tech companies, and they compete on stocks. So some of the things that they have to do, as I mentioned earlier, is getting leaner and the power of working efficiently. That means getting a smaller team and working efficiently. Locally, again, as tech employees, I think as I finish, is that in Kenya, the market itself is very still green in terms of startups, and it's still open. So I don't think tech employees should be so worried in Kenya. We should continue innovating, and we should not be worried about whatever is happening in the Silicon Savannah, the Silicon Valley. The Silicon Savannah is just fine. Thank you so much, Ro.
All right, thank you very much. I like the Silicon wordplay. And talking about Silicon, I like in studio we have Agnes Muthoni, who is the head of growth and strategy at Tala Kenya, and she joins us right now. Agnes, thank you very much for making time, which is very critical. Just briefly, looking at that curve, post-COVID, the hiring binge that we saw in some sectors of tech, I don't know for fintech, is the curve still the same, or is it changing slightly?
Yeah, thank you, Noah. That's a really interesting question. You know, when we look at, the overall trends in the tech space, together with also the fintech space, we're seeing similar trends, right? If you take a step back and you see what's been happening overall in the fintech market, what we're seeing is rising cost of credit, rising cost of consumption. So as a result of that, what we are seeing is we're seeing that customers or consumers are choosing to spend less in luxury goods, but they're choosing to borrow more, right? For general household expenses, they're choosing to borrow more. Maybe if you're an SME, they're choosing to borrow to be able to pay for their employee salaries. So in terms of how does that impact the fintech sector, on our side, what we are seeing is we're seeing a higher uptake in loans, but for general household expenses. Okay. So just to give you an example, last month, we actually saw a 50% uptake in loans as a result of the back to school period, right? And so those are similar trends that we're seeing in the fintech sector. Now, how it will impact companies in general in the fintech sector is we'll continue to see, that demand for lending, that will continue to be the case. However, it is still prudent. I like the segment before, whereby if you look at the trend, we're talking about leaner operations, being very lean in how you operate your businesses, in how you build your businesses, so that you can be able to extend your runway, your cost runway. And that's one of the things we've done at Tala. Right. One of the things we've done is we've been very prudent and intentional in how we build a sustainable business and how we're able to build a profitable business, yes, so that we retain, obviously, our business model, and we're able to invest in ensuring that we're providing more value to our customers, okay, and still retaining the structure that we have.
All right. And one of the biggest challenges that we've seen in the financial sector, and now you guys are on now fintech sector, but it's been the issue of non-performing loans, especially with the risk of the macros that have not been very favorable for a lot of people. You find these NPLs have been going up. Is it different for Tala? And just speak as an industry player, is it something that is of big concern?
Yeah, that's a really good point. And you are right. As we've continued to see the demand for loans going up, non-performing loans are also going up. So that's the reality of where we currently are with the current tough macro conditions. However, at Tala, our repayment rate still stands at 95%, which is pretty good. What has helped us maintain a high repayment rate are a number of reasons. Number one of the things we've done when we've looked at credit is we've spent time understanding who is borrowing from us, right? And how can we build a product that caters to their needs? So I'll give you a good example. We have a customer called Jennifer, and I'm sharing her name because it's public information. But here is someone who has a food stall. She's been able to borrow money from us. And what we did was we created our product in such a way that she can be able to choose her due date on when to pay us back, to align with her income patterns, right? And so what that does is it builds a lot more flexibility, right? And we've also done, the other thing we've built in is we've created a pricing model that is our interest rates are calculated on a daily basis. And so what that means then is you can choose to pay back your loan earlier and save more money. So we're offering interest rates on a daily basis at a reducing balance, which again incentivizes the customer to pay and save more at the same time. And so when you offer this level of flexibility, what you find then is you find that customers then have more options to be able to then pay back the loans. The other thing we've done is we've asked ourselves, what else can we do to be able to serve those individuals who are currently not being served in traditional financial institutions? And so we've leveraged machine learning and AI to be able to pull in alternative data sources so that we can be able to build a credit score for customers who do not ordinarily get access to loans. And as a result of that, that has been able to expand the customer segments that we can serve. But at the same time, what we've done is with the level of flexibility that we've built in, what it does is it encourages people to pay back. It gives people the options on when they can pay back. And what we've also done is we've extended grace periods so that when you're hit with an emergency or when you're hit with tough times, you still have at least some additional time to be able to pay us back.
Okay. And I'm seeing time is really moving. But let's talk this issue of FX, because it's been quite a concern. The shilling the other day was 160, and now it's just checked today, it's 142 according to the Central Bank of Kenya. This volatility, albeit now it's strengthening against the dollar, but initially it was the other way around. I don't know, as fintech sector players, does it impact you, especially those who are still receiving funding, which I know it's a big issue right now in 2024 is the year of now autonomy from funding. Talk to me about that.
Yeah, so that's a really good question, Noah, and you're right. Regardless of which sector you're in, whether you're in the fintech sector or whether you're in other sectors, that weakening of the shilling will impact you. And the reasons are very clear. As a result of the weakening of the shilling, what we will see is we've seen the cost of goods go up, right? We've seen inflation also go up. And so, number one, what's going to be important, obviously, is ensuring that you continue to remain innovative. And that's one of the things at Tala that we've done. We've invested a lot of time over the last few years asking ourselves, what more value can we provide to our customers so that we can be able to provide more value, provide additional product offerings so that we can continue to not only grow our business, but also to serve our customer needs. So today what you see is more flexibility with our credit. What we are also seeing is very soon we're going to start having capabilities where our customers can save money, our customers can transact, pay bills with us. Okay. Now, going back to what does that mean from a perspective of do we need to raise funds? I think because of the fact that we've built a sustainable business and we've built a diversified product offering, that enables us to tap into our existing funds for expansion plans or to continue running our business. So from a funding perspective, I like the question that you've asked around funding and also for other companies that may be looking to tap into funding. I think what is very interesting is Kenya today continues to remain an attractive market. One of the things that we can see, some of the data points that we can see most recently, we saw that last year, Kenya was able to surpass the amount of VC funds that it received, higher than places like Nigeria, South Africa, and Egypt. So Kenya continues to be an attractive market for funding, and we're excited about that.
Definitely, and I'm glad that the outlook is very bullish, as people call it in the market, and you even have a new CEO at NSE, which will be quite interesting. But I think it's a conversation, since it's just the beginning of the year, just slightly after Valentine's, that we can assess as time goes by some of these dynamics. But thank you very much, Agnes, for your time and for indulging us.
Thank you, Noah.
All right, there we go. Agnes Muthoni is the head of growth and strategy at Tala Kenyan. She's